In an era where the cryptocurrency landscape is evolving at lightning speed, companies are continuously innovating to meet the growing demands of users. Recent developments highlight both the challenges and opportunities emerging within the crypto space as investors navigate fluctuating market sentiments while tech pioneers unveil cutting-edge solutions. From advanced wallets to leveraged financial products, the crypto industry is poised for significant transformations. One of the most notable advancements is the introduction of Walletry.ai, a next-generation cryptocurrency wallet that promises to redefine how users interact with their digital assets. Launched on March 15, 2025, Walletry.ai is built with a multi-layered security infrastructure designed to safeguard users' funds. Its features include seed phrase protection, two-factor authentication, phishing protection, and an AI-driven behavioral analysis system that actively monitors for suspicious activity. Security remains the top priority for any crypto user, said a spokesperson for Walletry.ai, emphasizing the wallet's commitment to providing a safe environment for asset management. Furthermore, Walletry.ai does not limit users to popular cryptocurrencies like Bitcoin or Ethereum. Instead, it supports a diverse range of digital currencies, allowing seamless cross-chain transactions. This flexibility is crucial as the crypto market continues to expand and users seek efficient ways to manage their portfolios. The interface is designed with usability in mind, catering to both novice and experienced traders who desire a frictionless experience. As the wallet market becomes increasingly crowded, Walletry.ai distinguishes itself through its integration capabilities with crypto exchanges and DeFi platforms. This feature enables users to automate trading strategies and optimize their portfolios without constant manual intervention, a game changer for those looking to enhance their trading efficiency. On a broader scale, the cryptocurrency market is facing a significant disconnect between traders' short-term hesitations and the bullish outlook held by developers. According to Ari Paul, founder of Blocktower Capital, this divergence presents a unique opportunity for long-term investors. In a recent statement, Paul noted, "This is one of the starkest divergences I've seen in sentiment and fundamentals," suggesting that while traders may be bearish, the underlying development in the sector remains positive. Market data supports Paul's perspective. For instance, Bitcoin's price recently spiked, indicating a potential uptick in investor confidence. On March 14, Bitcoin rose by 3.16% to $84,638, while Ethereum and XRP also saw gains. "Clearly made a higher low, clearly touching the highs," remarked Michael van de Poppy of MN Trading Capital, reinforcing the notion that a new uptrend may be on the horizon. In addition, as Europe witnesses the launch of its first leveraged crypto exchange, traded notes ETNs, institutional investors are presented with new avenues for engagement. This development could signal a turning point for institutional participation in the crypto market, fostering greater legitimacy and stability in an industry often criticized for its volatility. The confluence of these trends suggests a pivotal moment for both investors and tech innovators within the cryptocurrency sector. With advanced wallets like Walletry.ai setting new standards for security and functionality and the potential for institutional investment on the rise, the future of cryptocurrency management appears more promising than ever. As the market matures, stakeholders will need to adapt to emerging technologies and shifting dynamics to capitalize on the evolving landscape. As the cryptocurrency market continues to navigate turbulent waters, a confluence of factors is shaping investor sentiment and asset performance. Recent developments in Bitcoin's price action. Regulatory shifts and emerging trends in alternative cryptocurrencies highlight the complex landscape that both seasoned and new investors are facing. Bitcoin, the flagship cryptocurrency, has encountered significant resistance around the $84,000 mark, reflecting broader market volatility. After reaching an all-time high of over $109,000 in January, Bitcoin's value has recently retreated, trading around $80,000, a decline of nearly 25% in just a few weeks. The sell-off has been exacerbated by a downturn in global stock markets and ongoing concerns regarding macroeconomic stability, particularly in light of rising geopolitical tensions and inflationary pressures. New investors drawn into the market by Bitcoin's previous rally are feeling the brunt of this downturn. A staggering 20 million new Bitcoin addresses have been created in the past 3 months, representing about 1.5% of all existing addresses according to data from Glassnode. However, many of these new holders may find themselves locking in significant losses, as indicated by the spent output profit ratio dipping below 1 for the first time in over a year. This ratio, which compares the prices at which Bitcoin is bought and sold, suggests that recent buyers are facing an uphill battle. The situation has prompted analysts to express concern over the sustainability of recent price movements. This corrective sell-off has caught many by surprise, noted John Glover, Chief Investment Officer of crypto lending platform Len. While some support may emerge around the $73,500 level, the overall market remains sensitive to broader economic indicators. In contrast, alternative cryptocurrencies have shown resilience. Both Solana's SOL and XRP have surged by 5% within the past 24 hours, with Solana benefiting from a recent governance vote that preserved its inflation schedule. Meanwhile, Ripple Labs, which oversees XRP, has made headlines by securing a payments license in the UAE and nearing the resolution of its protracted legal battle with the U.S. Securities and Exchange Commission. These developments have instilled a sense of optimism around these assets, contributing to their recent price increases. Moreover, the recent rally of memecoins like Dogecoin and Pepecoin underscores a shift in trader behavior towards higher-risk assets in the face of Bitcoin's sideways trading. As Bitcoin's price stagnates, speculators are increasingly looking for volatility and potential gains in these more speculative corners of the market. However, the overall outlook remains cautious. Market analysts, including Annie Ling of WeFi, highlight that while cooling inflation could pave the way for potential interest rate cuts later in the year, ongoing geopolitical tensions and a complex economic landscape add layers of uncertainty. Bitcoin's recent volatility reflects its evolving role as a risk-on asset rather than a traditional store of value, Ling stated. As traders brace for further price fluctuations, attention will remain focused on Bitcoin's ability to break through crucial resistance levels. Alex Kupsikevich, chief market analyst at FX Pro, suggests that a sustained move above the $89,000 threshold could signal a return to bullish sentiment. For now, however, the market remains in a precarious state, with many investors left wondering when the next significant move will occur. In conclusion, as Bitcoin grapples with resistance and a bear market that has disproportionately affected new investors, Solana and XRP's recent gains highlight the potential for niche assets to thrive amid broader challenges. The coming weeks will be critical for the cryptocurrency landscape, with macroeconomic indicators and regulatory developments likely to play pivotal roles in shaping market trajectories. Bitcoin, the flagship cryptocurrency, has faced significant turbulence in recent weeks, leaving many new investors reeling from the sharp downturn. Following an explosive rally that saw Bitcoin surge past $100,000 in January, the digital asset has plummeted to around $80,000, marking a decline of nearly 25% within a matter of weeks. This steep drop is largely attributed to a broader sell-off in global equities, which has drained investor confidence across markets. In the wake of Bitcoin's meteoric rise, approximately 20 million new Bitcoin addresses were created in the last 3 months, a surge that represents about 1.5% of all existing addresses according to data from Glassnode, a prominent crypto analytics firm. Many of these new investors entered the market during the height of the rally, drawn in by the excitement surrounding the cryptocurrency's performance. However, the recent downturn has left many of them grappling with significant losses. The spent output profit ratio, which measures the profitability of Bitcoin transactions, has recently dipped to 0.95, its lowest level in over a year. This indicates that recent buyers are locking in substantial losses, according to analysts from Bitfinex. This suggests that recent buyers are locking in significant losses, reinforcing the exceptionally challenging conditions for newer investors, noted the analysts. Kevin Deedy, an analyst at investment bank H.C. Wainwright, expressed surprise at Bitcoin's current valuation, stating, "I was surprised to see Bitcoin at $80,000 and it looks like the bloodletting hasn't ended yet." The market's volatility has been exacerbated by external factors, including uncertainties surrounding U.S. economic policy and a recent executive order from President Donald Trump aimed at creating a U.S. crypto reserve. While this move initially provided a temporary boost to the market, it has not been sufficient to stem the tide of selling pressure. John Glover, chief investment officer at crypto lending platform Ledn, mentioned that the asset might find support around the $73,500 mark, but the future remains uncertain. Traders employing leveraged positions have suffered the most, with realized losses exceeding $800 million per day in recent weeks. Notably, investment products tracking digital assets have seen outflows for 4 consecutive weeks, with total assets under management plummeting to $142 billion, their lowest point since November 2024. In a related development, Robinhood has expanded its cryptocurrency offerings by listing 3 new meme coins: Pengu Pengu, Peanut the Squirrel PNUT, and Popcat. This move comes amidst a broader trend of U.S. crypto exchanges capitalizing on the meme coin phenomenon, particularly following Trump's election. Despite this expansion, the market reaction has been tepid, with each token experiencing gains of less than 20%. This reflects the overall subdued interest in altcoins as Bitcoin struggles to maintain its position above $80,000. Furthermore, a recent call from a Democrat lawmaker urged the U.S. Treasury to abandon Trump's plans for a Bitcoin reserve, highlighting the contentious political landscape surrounding cryptocurrencies. The regulatory environment continues to evolve, with the SEC recently ruling that many meme coins do not qualify as securities, a significant shift from its previous stance. As Bitcoin and the broader cryptocurrency market navigate these tumultuous waters, analysts predict that while sell-offs often precede periods of recovery, the current landscape remains unpredictable. Investors are advised to exercise caution and remain informed, as developments in both market dynamics and regulatory actions could significantly impact the future trajectory of digital assets. The coming weeks will be critical in determining whether this latest bear market is a short-term correction or a sign of deeper issues within the cryptocurrency ecosystem. As the cryptocurrency market continues to navigate its turbulent waters, Ethereum ETH finds itself at a pivotal moment, grappling with both setbacks and glimmers of hope. Recent developments, particularly within Europe's financial ecosystem, suggest that institutional acceptance of Ethereum may be on the rise, yet the landscape remains fraught with uncertainty. On March 11, a subsidiary of Deutsche Börse, Germany's largest stock exchange, announced its intention to offer custody services for Ethereum alongside Bitcoin for its institutional clients starting in April. This move marks a significant step for Ethereum, especially in a European market that has historically been cautious about embracing cryptocurrencies. This is an undeniably positive development for holders of Ethereum, said a market analyst. However, the question remains, will this be enough to rejuvenate Ethereum's flagging demand? Ethereum has experienced a dramatic decline over the past year, losing nearly half of its value. As of March 15, 2025, ETH was trading at around $1,928.29, a stark contrast to its prior highs. The optimism surrounding its new custody capabilities is tempered by the fact that institutional investors are still wary of the inherent volatility associated with cryptocurrencies. Analysts suggest that while the Deutsche Börse services may pave the way for increased adoption, significant volume shifts remain unlikely in the immediate future. Even if Ethereum captured just 1% of Deutsche Börse's cash volume, it might not make a meaningful impact on overall demand, one expert noted. Despite potential institutional interest, Ethereum's fundamental challenges persist. Notably, its competition with faster and cheaper blockchain solutions like Solana looms large. Without substantial advancements to improve its competitive edge, Ethereum risks further stagnation. There are currently no plans to onboard Solana to Deutsche Börse, but that doesn't alter the fact that Solana continues to outpace Ethereum in terms of performance, the analyst added. Market sentiment remains mixed, further complicated by recent price volatility. A sharp 13% drop in Ethereum's value has sparked discussions on social media, with many speculating whether this could signal a bottom or if further declines are imminent. As Ethereum struggles with its identity and market position, investors are left weighing the potential for recovery against the backdrop of ongoing risks. In light of these developments, the future of Ethereum hangs in a delicate balance. If more European exchanges follow Deutsche Börse's lead, or if institutional interest in Ethereum's custody services surges unexpectedly, it may be time to reassess the cryptocurrency's investment viability. Until then, many experts advise caution, advocating for a strategic wait-and-see approach as the market recalibrates. As Ethereum moves forward, the unfolding narrative will inevitably shape not only its trajectory but also the broader acceptance of cryptocurrencies in traditional financial markets. For investors, the time to act may come, but for now the focus should remain on the evolving landscape and the potential implications of these pivotal changes. In the rapidly evolving world of blockchain technology, speed has emerged as a critical competitive advantage, especially as decentralized applications, dApps, and exchanges gain in popularity. A new initiative spearheaded by a group of former Solana executives and high-frequency trading HFT veterans aims to revolutionize the blockchain landscape by establishing a private, high-speed internet network tailored for blockchain communications. This project, known as 00, seeks to accelerate transaction speeds and enhance the overall efficiency of blockchain operations. Austin Federa, co-founder of 00 and a former executive at the Solana Foundation, articulated the vision behind this groundbreaking endeavor, stating, "We can use a whole different set of technologies that have basically been standard and de facto in the high-frequency trading world, but are not available over the public internet, so they've never been applied to blockchain before." This indicates a strategic shift in leveraging established HFT infrastructure to solve the latency issues currently plaguing public blockchain networks. The ambitious project has already garnered substantial financial backing, raising $28 million in a seed round led by prominent crypto investors such as Multicoin Capital and Dragonfly Capital. Additional support came from firms like Foundation Capital and Reciprocal Ventures, which collectively valued 00 at approximately $400 million. However, Federa, while acknowledging the funding, remarked, "Private market valuations are worth the paper they're written on," hinting at the uncertainty that often accompanies such assessments. At the heart of 00's strategy is the recognition that existing blockchain networks like Solana and Ethereum rely heavily on public internet infrastructure for communication between their servers. This reliance can introduce latency that slows down transaction processing and diminishes user experience. By creating a private network of cables, 00 aims to bypass these limitations, potentially leading to faster and more robust blockchain operations. The technical execution of this vision involves collaboration with Jump Crypto, the digital assets subsidiary of Jump Trading, and Malbec Labs. Interestingly, the infrastructure won't initially involve laying down new physical cables. Instead, the team plans to utilize underutilized bandwidth from various sources, including HFT firms and private entities, to create a more efficient communication network. This approach not only reduces costs but also aligns with the decentralized ethos of blockchain technology. To incentivize contributions to this network, the 00 Foundation plans to launch its own cryptocurrency. This currency will reward those who provide bandwidth, ensuring that the network remains decentralized and community-driven. The co-founders, including former Neutrona Networks CEO Matteo Ward and ex-Jump engineer Andrew McConnell, bring a wealth of experience in building specialized networks, further bolstering the project's credibility. As the crypto landscape continues to mature, innovations like 00 highlight the ongoing need for technological advancements that can support the explosive growth of blockchain applications. With increasing transaction volumes and user engagement, the demand for speed and efficiency will only intensify.
If successful, 00 could set a new standard for blockchain infrastructure,
enabling a hyperfast internet that enhances the performance of decentralized applications across the board. Looking ahead, the success of 00 may not only influence the operational efficiency of existing blockchains but could also inspire new projects to explore similar private networking solutions. As the initiative progresses, it will be essential to monitor its impact on transaction speeds, user experience, and the broader crypto ecosystem, setting the stage for future developments in blockchain technology.